Today, we will listen to and unpack 7 crucial investing lessons from Warren Buffett's annual Berkshire Hathaway meeting. If you are new to investing, these lessons will cover the fundamentals of investing and help you build a solid long-term investment philosophy. My name is Kanak and welcome back to my channel. For more such video on investing, subscribe to my channel, and if you find this video helpful, hit that like button and share the video. With that said, let us listen to the first investing lesson from Warren Buffett.
Investing is laying out money now with the hope of getting back more later on. It's really laying out purchasing power now with the hope of getting more purchasing power back. But that's the reason that's the way you learn in the textbooks, that you defer consumption now so you can consume more later on so that you can take care of your family. All these things about how investment takes place. And that is what happens with farms. I mean, somebody buys a farm and they hope to leave it to their kids, or they got it from their parents. And I mean, they don't sit there every day and get quotes 15 times a day and say, I'd like to get a call. I'd like to sell a put on the guy's farm next to me, and you can have a call on mine, and then I'll have something called a straddle or a strangle or whatever it may be. And they go about making the farm worth more money. And
the primary aim of every investing activity is to beat inflation and increase the purchasing power of your money. In simple words, you want to be able to buy more with your money in the future than what you can buy today. Let us look at how investing in stocks has performed compared to inflation. After adjusting for inflation, $10,000 in 1994 would be equivalent to having about $20,000 in 2024. But if you had invested the same $10,000 in S&P 500 stock index in 1994, it would have turned into $200,000 by 2024. This means that by investing in the stock market index, your money would have beaten the inflation by almost 10 times over 30 years. So the goal of investing in any asset class such as bond, real estate, stocks or any other is to increase the purchasing power of your money. With that said, let us listen to the next lesson.
We have not been good at timing. We've been reasonably good at figuring out when we were getting enough for our money. And we had no idea when we bought anything. Well, we always hoped it would go down for a while so we could buy more. And we hoped even after we were done buying and ran out of money that if it was cheap, the company would keep buying, and in effect taking our interest up. I mean, that stuff you could learn it in 4th grade. But it's not what's taught in school. So never give us any credit. Well, actually, give us all the credit. Go out and tell everybody how smart we are, but we aren't. We haven't ever timed anything. We've never figured out insights into the economy.
In this clip, Warren Buffett talks about 2 approaches to picking stocks: bottoms up and top down. Bottoms up means focusing on and analyzing the value of individual businesses rather than making investment decisions based on big macroeconomic factors like recessions or market booms. Many investors spend too much time trying to predict the next market crash or economic downturn. Often news channels hype market crashes or booms, creating excessive noise. Most experts in media often fail to predict and time the market correctly. So it's a futile exercise to try to predict the short-term market moves or economic shifts in the short term. Now let us listen to the next lesson.
In looking at money management, the game is not performance, it's assets under management. And index funds produce a tiny fee on assets under management because it was pioneered by Vanguard, and it's when it became successful, it was very easy to replicate. Not so easy, but it was inevitable to be copied. But it came with a management fee of 2 basis points. So what people that have offered index funds would really like is you to buy their other funds or let them manage money in some other way so that they get a higher fee on assets under management, which of course is exactly why the index fund was invented in the first place. And essentially give up the idea, and that we'll offer you a fund that does this in India, and we'll offer you another fund that does that. And of course, those management fees are higher. So they're really counterselling the idea that John Bogle came along with.
This is a very important lesson. Fund managers charge a fee based on the assets they manage, taking a percentage of your invested money. Index funds have super low fees, sometimes just 0.02%, because they are passive. They don't involve managers picking investments. On the flip side, actively managed mutual funds charge higher fees, ranging from 0.5% to 1.5%. Because managers are actively choosing investments. The mutual fund industry often aims to sell more actively managed funds to rake in those high fees. But surprisingly, over 90% of actively managed mutual funds fail to consistently beat the index over long periods, like 10 or 20 years. So investing in actively managed funds often means paying higher fees with a good chance of getting lower returns compared to the index over 10 or 20 years. With that said, let us now listen to the next lesson.
And float is money that is left in our hands, somewhat akin, but very importantly different than a bank deposit. But you have to pay interest to get a bank deposit. You have to pay more interest these days, and you have to run a bank and do a lot of things. And basically, this is money that represents unpaid losses at this time. You get paid in advance in insurance. So what shows up as a net liability on our balance sheet gives us funds to exercise with an amount of discretion that no other insurance company that I know of in the world enjoys, just because we have so much net worth. And our float now comes to $165 billion, to this incredible figure, which in most years, practically all years, hasn't cost us anything. So it's like having a bank with no employees, no interest, and no ability to withdraw the money in a hurry that we have working for us. And it's a very valuable asset that
one of the key pillars of Berkshire Hathaway's financial success comes from something called float money. This is the premium that insurance companies collect from selling insurance. Here is how it works. When you buy insurance, you pay the premium upfront. But the insurance company only pays out if the risk event happens later, like a car crash. During that time in between, the insurance company can invest your premium money to make even more money. That's the float. It's like interest-free cash for the insurance company to invest. Berkshire Hathaway's success is also thanks to Ajit Jain, who's great at underwriting insurance and has helped Berkshire generate billions of dollars in float money. Warren Buffett then invested this float money and earned market-beating returns for multiple decades. This combination of lots of float money and investing outperformance has made Berkshire Hathaway hugely successful.
we're learning all the time how consumers behave. I'm not going to be able to learn the technical aspects of businesses, but that'd be nice if I knew it, but it isn't essential. And we are obviously, we've got a business at Apple which is larger than our energy business, and we may only own 5.6 or 7%, but our ownership goes up every year. And I don't understand the phone at all, but I do understand consumer behavior. And I know how people think about whether to buy a second car. I know how they go out to different, we own auto dealerships. We're learning all the time from all of our businesses how people react to granimals versus, selling them something else. And
Warren Buffett looks for businesses with a strong moat, which means they have a competitive advantage. Understanding consumer behavior helps identify this advantage. One example is knowing how consumer behavior is influenced by brands, which helps to spot a moat in a business. Consumers often stick with brands for two main reasons: trust and social validation. We trust well-known brands because we feel safer with what's familiar and try to avoid fear of the unknown. Secondly, brands give us a sense of status among our friends and colleagues. People are often willing to pay extra for brands, which gives those brands a massive pricing power. Buffett says knowing consumer behavior is crucial for spotting great businesses. With that said, let us now listen to the next lesson.
If you tell me you own 1% of the apartment houses in the United States and you offer me a 1% interest, so I'll have a 1% in all the apartment houses in the country, and you want whatever it may be for it, then call it another $25 billion or something. I'll write you a check. It's very simple. Now, if you told me you owned all of the Bitcoin in the world and you offered it to me for $25, I wouldn't take it, because what would I do with it? I have to sell it back to you one way or another. I mean, maybe I have the same people, but it isn't going to do anything. The apartments are going to produce rental, and the farms are going to produce food. And if I've got all the Bitcoin, I'm back where whatever his name was, who may or may not have existed, was 15 years ago. If I've got it all, he could create a mystery about it. But everybody knows what I'm like. I mean, so if I'm trying to get rid of it, people will say, well, why should I buy some Bitcoin from you? I mean, why don't you call it Buffett coin? Make your own or something. Do something. But I'm not going to give you anything for it. And you'd be right, incidentally. But that explains the difference between productive assets and something that depends on the next guy paying you more than the last guy got. Now,
Buffett points out that unlike stocks, bonds, or real estate, cryptocurrencies do not create economic value for society. Bitcoin, for example, does not produce any tangible value. As it is not backed by any government, its price is solely determined by the supply and demand. However, it is important to distinguish between blockchain technology and cryptocurrencies. Blockchain technology removes the need for a central authority to track transactions and decentralizes record keeping across multiple servers on the internet, whereas cryptocurrency is just one use case of blockchain, eliminating the need for record-keeping central authorities like banks. While blockchain technology has promising future applications, it is still in its early stages, and the transaction friction limit its uses, making it difficult to assess its true value. On the other hand, whether cryptocurrencies will ever become a reliable store of value remains uncertain.